Welcome. Over the past 9 sections, you have learned every phase of the inventory and cost accounting cycle, from procurement all the way through controls and risk. Now comes the part that turns knowledge into advisory value. In this section, you will learn a repeatable 5-step method for assessing any inventory holding client, plus how the cycle flexes across different business models. Think of this as the section where everything you have learned finally gets put to work. Let's set out what you should be able to do by the end. First, apply a structured 5-step method to assess any inventory holding client, regardless of industry. Second, explain why the cost accounting steps are what separate a real advisor from a bookkeeper. Third, identify how the cycle runs differently across business models, from traders to import-heavy manufacturers. Fourth, define the specific advisory focus that matters most for each client profile. And finally, recognize where the accuracy and control risks tend to concentrate, so you know where to look first. Here's the key thing about working with inventory clients. You don't need a different approach for every business. You need one method you can apply anywhere. This 5-step method works for any inventory holding client, whether they trade, assemble, or manufacture. Pay close attention to steps 3 and 4, because those are the cost accounting steps, and they are exactly what distinguishes an advisory approach from a bookkeeping approach. Most clients can keep their own books well enough, but they need real help with cost accuracy and variances. That is where you add value, and that is where we are headed next. Start by understanding what kind of client you are dealing with. Are they a trader, a light assembler, a batch manufacturer, or a discrete manufacturer? Do they use job order, process, or activity-based costing, or some combination? Is there a standard cost system in place, and are those standards updated annually? Ask about the predetermined overhead rate, the POR, and when it was last recalculated. These answers are not just background. They determine which cost accounting stages actually apply to this client, and where the accuracy and control risks are concentrated. Get this wrong, and you'll spend time on stages that don't even exist for them. Here's a problem you'll see constantly. Many clients expense freight and duties instead of capitalizing them into inventory. That understates inventory and distorts margins. So pull a sample of recent purchase transactions and verify the math. Supplier invoice plus freight plus duties should equal the inventory value in the system. If it doesn't, quantify the gap and recommend a correction. And don't stop at the purchasing side. Check that the standard material cost in the cost card reflects the full landed cost, not just the supplier invoice price. A standard built on invoice price alone will quietly mislead every margin calculation downstream. Now we reach the first cost accounting step, where the real advisory work begins. Ask for the standard cost cards for the top 5 products by revenue. Compare the standard material cost to the most recent landed cost. Compare the standard labor hours to recent time studies or production data. Then calculate the actual overhead rate. That's actual overhead divided by the actual allocation base, and compare it to the POR. Large variances from any of these comparisons tell you something important. Either the standards are outdated, or the costing system isn't working as designed. Either way, you've just found something the client needs to fix. The second cost accounting step is about how the client uses their variance data. Ask for the most recent monthly variance report covering all 9 variances. Then ask the harder questions. Are significant variances actually being investigated? Are root causes documented? Are corrective actions taken? Here's the tell. If variances are routinely closed to cost of goods sold without any investigation, the client is not using cost accounting as a control tool. They're using it as a bookkeeping mechanism. The variance report is one of the most valuable management information outputs the whole system produces, and a client who ignores it is leaving real money on the table. The final step closes the loop on the numbers themselves. The inventory subledger versus general ledger reconciliation is the primary detective control over inventory. Combine it with the inventory aging report, which drives your lower of cost or net realizable value assessment, LCNRV, and together they give comprehensive coverage of completeness, accuracy, and valuation. Now here's the warning. If neither reconciliation is being performed regularly, the inventory balance sitting on the balance sheet is essentially unverified. That's a number nobody can stand behind, and for a material asset, that should concern you immediately. With the method in hand, let's talk about how the cycle adapts. The 6 phases apply universally, but 2 of them flex significantly depending on the business. Phase B, the cost accounting setup, and Phase D, variance analysis. A trader barely touches them. A manufacturer lives in them. So rather than applying every stage the same way to every client, you tailor your advisory focus to the client's profile. Over the next few slides, we'll walk through 5 common profiles, and for each one, I'll point you to the single thing that matters most. That focus is what makes your advice land. Let's start with the simplest profile: trading, wholesale, and retail. These clients have no manufacturing, so only phases A, E, and F apply. There's no POR, no work in process, and no variances to chase. That simplifies things, but it shifts the spotlight. Landed cost accuracy becomes the primary valuation challenge, and LCNRV is critical, especially for fashion, technology, or perishable goods that lose value fast. Your advisory focus here is landed cost accuracy, an ABC cycle count program, the retail inventory method for interim estimates, and gross margin analysis by SKU. Simple cycle, but valuation is where they get hurt. Now the manufacturers, where phases B, C, and D come fully alive. For batch and process manufacturers, think process costing with equivalent units, normal spoilage built into the standard BOM and abnormal spoilage expensed, and yield variance as the key metric. Your focus is equivalent unit consistency, normal loss rate accuracy, and yield variance root causes. For discrete and job order manufacturers, each order carries a job cost sheet, and work in process equals the sum of open sheets. Watch POR adequacy and old open jobs, which often signal untransferred finished goods. And for ABC adopters, activity rates replace the single POR, so validate that the drivers are still relevant and measurable. The last profile is the import-heavy business, where landed cost complexity reaches its peak. You're dealing with HS code classification, anti-dumping duties, and currency risk all at once. Here's the trap to watch for. The standard material cost in the BOM should be reviewed whenever major Incoterms or supplier routing changes occur. If it isn't, a standard that no longer reflects current duties and freight will generate permanent material price variances until somebody updates it. Your advisory focus is duty optimization through free trade agreements, bonded warehouses, or duty drawback, plus HS code review and a currency hedging strategy. This is where deep expertise really pays off. Let's bring it together. You now have one repeatable 5-step method that works for any inventory holding client, and you understand that steps 3 and 4, the cost accounting steps, are what separate advisory from bookkeeping. Remember that the 6 phases apply universally, but Phase B and Phase D vary most by business type, so you tailor your focus to the client's profile, whether they're a trader, a manufacturer, or an importer. And keep your eyes on the warning signs, unverified balances, and stale standards. Next, we'll put all of this into practice with worked failure cases and fixes. Thank you for completing this section on applying the cycle to any client.